A small group of financial companies now shapes the U.S. economy in ways most people never see. Their decisions affect paychecks, rent, prices, and retirement accounts, even if the average person has never heard their names. These companies are large asset management and private equity firms such as BlackRock, Vanguard, State Street, KKR, and Carlyle. Together, they manage tens of trillions of dollars for pension funds, retirement plans, insurance companies, and governments. They do not write laws, but they strongly influence which businesses receive money, which companies survive, and who carries the financial risks when things go wrong. The purpose of this lecture is to explain, in clear terms, how these firms work, how they became so powerful, and how their choices affect everyday life in the United States. The main question is this: to what extent do large asset management and private equity firms harm or weaken the economic position of ordinary Americans? An asset management firm manages money for other people. When someone contributes to a 401k, an IRA, or a retirement plan at work, that money usually goes into mutual funds or exchange-traded funds, ETFs. These funds are run by asset managers. You can imagine a very large pool of savings. Millions of people and organizations pour their money into this pool. The asset manager decides how to spread that pool across many investments: stocks of public companies, government bonds, real estate trusts, and other assets. The goal is to protect and grow that money over time. Private equity firms work differently. Instead of buying small pieces of many public companies, they buy whole companies or large controlling stakes. They often use a mix of investor money and borrowed money. After buying a company, they try to make it more valuable by cutting costs, changing leadership, selling off certain parts, or changing the business strategy. After a few years, they try to sell the company for more than they paid. In very simple terms, asset managers say, let us spread your savings across many different investments so you do not have to pick stocks yourself. Private equity firms say, let us buy entire companies, change them, and sell them later for a profit. Now, these roles are not automatically bad. Asset managers make it possible for ordinary people to invest in markets without becoming experts. Private equity firms can sometimes rescue failing businesses or fix serious problems. The concern is not that these models exist. The concern is how large they have become, how much of the economy they now touch, and how much power is concentrated in the hands of a few firms. The rise of large asset managers and private equity firms did not happen overnight. It built up over several decades. In the 1970s, Jack Bogle at Vanguard introduced the index fund. Instead of trying to beat the market, an index fund simply buys small parts of many companies at once, following a list such as the S&P 500. This lowers costs and, over long periods, often does better than more expensive funds run by stock-picking managers. As more people and institutions chose index funds, huge sums of money flowed to the companies that offered them. Vanguard, BlackRock, and State Street became enormous. They did not grow by making risky bets. They grew by becoming the default choice for retirement savings, both for individuals and for big institutions like pension funds. In the 1980s, private equity firms also grew quickly. They used leveraged buyouts, which means buying companies with a lot of borrowed money. Famous deals, such as the takeover of RJR Nabisco, showed that this model could produce very high profits. Over the following decades, several trends reinforced this growth. Large pension funds and insurance companies wanted higher returns and sent more capital to private equity funds. Employers moved away from traditional pensions and toward 401k style plans, which pushed more responsibility for investing onto workers and indirectly onto asset managers. Technology made it easier and cheaper to manage giant portfolios of assets across the world. By the early 2000s, and especially after the 2008 financial crisis, these firms were no longer just one part of the financial system. They had become central to how that system worked. When people refer to the market today, a large share of that market is actually controlled by decisions made inside a few very large asset management and private equity firms. To see why this matters, we have to move from theory to daily life. The influence of these firms can be seen in 4 areas: housing, employment, retirement, and local communities. Housing. After the 2008 housing crash, millions of homes went into foreclosure. Many families lost their houses. Entire neighborhoods had rows of for sale signs. Large investment funds saw an opening. Instead of many individual families slowly buying these houses, big firms, including private equity funds, began buying thousands of homes at a time. They turned many of these homes into rental properties. In some cities, especially in parts of the Sun Belt, corporate landlords now own a noticeable share of single-family homes. For renters, this often means dealing with a large company rather than an individual landlord. For first-time buyers, it means facing competition from investors who can pay in cash and move quickly. The basic effect is clear. When a large share of homes are treated mainly as investment products, the housing market becomes more sensitive to the plans and profit goals of faraway investors. Choices about rent levels, repairs, and who gets to live where are influenced not only by local supply and demand, but also by national and global financial strategies. Employment. When a private equity firm buys a company, its main goal is to increase the company's value within a set number of years. Sometimes this involves real improvement, better management, more efficient operations, or new lines of business. However, it often involves cutting costs, closing branches, laying off workers, lowering benefits, or reducing long-term investments like training and research. Research and government reports have found that, in many industries, companies taken over by private equity firms experience higher job losses and, in some cases, more bankruptcies. This has been especially visible in retail, local newspapers, and parts of healthcare. Not every deal has this outcome, but the pattern appears often enough to raise concern. It shows how the pressure to deliver fast financial returns can conflict with the needs of workers and communities. Retirement. For most Americans, the main connection to financial markets is through retirement savings. Traditional pensions, which promised a fixed monthly payment in retirement, have mostly been replaced by plans where the final amount depends on how investments perform. These investments are heavily concentrated in funds run by large asset managers. This structure has advantages. Investments are diversified and costs are generally low. But it also means that the security of millions of workers in old age depends on the decisions of a small group of firms. These firms choose which companies are included in key index funds. They vote on corporate decisions. They decide how actively they will push companies on issues like risk management, worker treatment, or long-term planning. Local communities. In addition to housing and companies, large financial firms also invest in infrastructure, hospitals, utilities, and city centers. This means that decisions about whether a hospital remains open, whether a local newspaper keeps its reporters, or whether a toll road is expanded are often influenced by the financial goals of distant investors. A facility might close not because it is unneeded, but because it does not meet the return targets set by its owners. Across these areas, the same pattern appears. Decisions that strongly affect daily life are shaped by institutions whose main duty is to produce returns for investors who may never set foot in the communities affected. History provides context for understanding what concentrated financial power can mean for a society. In the 17th century, the Dutch East India Company became one of the world's first multinational corporations. It controlled key trade routes and had great influence over Dutch economic policy. For a time, it brought wealth to the Netherlands. But as it grew larger and more indebted, problems inside the company began to hurt the wider economy. One firm had become so central that its troubles became a national concern. The lesson is simple. When one institution sits at the center of trade and finance, its decisions can affect the entire country. In 18th century Britain, the South Sea Company is another example. It took on government debt and promised big profits from trade. Excitement and speculation pushed its stock price far beyond any realistic value. When the bubble burst in 1720, many investors lost money, and trust in the financial system was damaged. The simple point is that when a financial scheme grows very large and complex, its collapse can harm both private investors and public finances. In the late 1800s and early 1900s, the United States saw heavy concentration in industrial sectors. Companies like Standard Oil controlled huge portions of the oil industry. Their economic power translated into political influence. Over time, public pressure led to antitrust laws and court cases that broke up or limited these monopolies. The goal was not to destroy business, but to prevent one company or group from having too much control over key parts of the economy. These episodes are not identical to today's world of index funds and private equity. However, they show a repeating theme. When a small number of actors hold a great deal of economic power, the stability and fairness of the wider system depends heavily on their choices. Today, large asset managers and private equity firms occupy a position that, in some ways, plays a similar role in the U.S. economy. Large financial crises often bring these structures into sharp focus. The financial crisis of 2008 and the COVID-19 shock of 2020 both reveal how deeply these firms are woven into the system. In 2008, the collapse of the housing market left banks and investors holding complex, mortgage-related assets whose value was unclear. The government needed help to analyze these securities and manage large portfolios through the cleanup process. Big asset managers, especially BlackRock, were hired for this role because they already had the systems and data to work with such instruments. In 2020, the sudden stop in economic activity caused by the pandemic again shook financial markets. The Federal Reserve created emergency programs to support bond markets and keep credit flowing so companies could continue to operate. Once again, a major asset manager was brought in to help run parts of these programs, including buying corporate bonds and bond funds, some of which were managed by that same firm. From a practical point of view, this made sense for policymakers. They turned to firms that knew how to manage large portfolios quickly and at scale. At the same time, this choice blurred the line between public policy and private interest. Firms that benefit from stable markets were also helping design and carry out the stabilization measures. The result is that these firms are now central not only in normal times, but also in emergencies. The system relies on them as both market participants and public partners. That deeper dependence raises questions about how transparent these relationships are, how conflicts of interest are handled, and how much influence private firms should have over public rescue efforts. To give a balanced view, we should consider why many economists, policymakers, and investors defend these institutions. First, low-cost index funds have been a major improvement for ordinary savers. Lower fees mean that more of the investment return stays with the person who is saving. Over a working lifetime, the difference between high fees and low fees can add up to a large sum of money. Second, large asset managers can act as stable, long-term owners of companies. Because they follow broad indices, they are less focused on day-to-day price changes and more on long-term performance. This can reduce some kinds of market instability. Third, private equity firms can sometimes rescue or strengthen companies that are in trouble. They can bring new capital and new management ideas. In some cases, they keep a business alive that might otherwise have failed outright. Fourth, these firms help big pension funds and public plans, such as those for teachers or firefighters, gain access to types of investments that would otherwise be hard to reach, like major infrastructure projects or private companies. These benefits are real and explain why so much money continues to flow into these firms. The issue is whether the side effects of this model, especially at such large scale, create problems that must be addressed through better rules and stronger oversight. The key risks associated with large asset managers and private equity firms can be stated in straightforward terms. First, heavy influence over corporate decisions. When the same few asset managers are among the top owners of most large companies, their views and votes matter a great deal. They influence how much executives are paid, whether companies merge, and how firms respond to issues like climate risk or labor practices. Second, possible weakening of competition. If the same investors own large stakes in several competing firms in the same industry, for example, multiple airlines or multiple banks, they may prefer that all firms stay profitable, rather than encouraging one firm to cut prices aggressively and gain market share. This can affect how competitive markets feel to customers, even without any illegal agreement. Third, pressure on workers and towns. In deals that involve large amounts of borrowing, private equity owners often push hard for cost cuts. That can mean lost jobs, reduced benefits, and fewer long-term investments. In fields like healthcare and elder care, this financial pressure can also affect the quality and availability of services that people depend on. Fourth, the risk of being too central to fail. These firms are not banks in the traditional sense, but markets and public programs now rely heavily on their systems and expertise. Serious trouble at one of these institutions could spread quickly, affecting retirement accounts, corporate financing, and even government operations. When a few financial firms sit at the center of many important economic decisions, their choices and their mistakes can have wide and deep effects on everyday life in the United States. The central point is that the United States has slowly built an economic system in which large asset management and private equity firms act as main gatekeepers for money. They do not officially set economic policy, but in practice they help decide which companies get funded, which industries grow, and which business models survive. They do this when they decide which firms are included in major indexes. They do it when they vote on who sits on corporate boards and how companies respond to key issues. They do it when they choose which private companies to buy, close, or expand. They do it when they work with the government to manage financial crises. In this role, they resemble earlier powerful actors such as dominant railroads, industrial trusts, or major banking families. Those institutions also performed important economic functions, but their central position raised questions about fairness, stability, and democratic control. Today's asset managers and private equity firms occupy a similar place in a far more complex and global financial system. The right response to this reality is not fear, but understanding and engagement. To participate meaningfully in debates about the future of the American economy, citizens need a clear picture of how these firms operate and why their power matters. For individuals, several steps are possible. Look at your retirement accounts and see which firms manage your funds. Remember that the market is not an invisible force, but a set of institutions run by people with specific goals and incentives. Pay attention to news about corporate landlords, private equity purchases, and ownership concentration in your city or state. For policymakers and regulators, the challenge is to decide whether current laws adequately address the problems that come from concentrated financial power. This may involve requiring more transparency about how asset managers vote on shareholder issues, considering ownership concentration when evaluating competition and antitrust questions, setting limits on certain types of purchases, for example, large-scale buying of single-family homes, when they undermine basic social goods like affordable housing, clarifying rules when private firms are hired to assist with public rescue programs to reduce conflicts of interest. For educators and students, the implication is that asset management and private equity should be part of the core curriculum when discussing modern economics and political economy. These institutions are no longer niche topics. They help define how economic power is organized in the 21st century United States. Returning to our main question, whether these firms negatively influence the United States and the daily lives of its citizens, The answer is complex. They provide real benefits, such as low-cost investing and access to capital. Yet their scale and concentration also bring risks to competition, to workers and communities, and to the stability of the financial system itself. History suggests that when financial power becomes central to a nation's life, societies eventually have to decide how that power is guided, limited, and aligned with democratic values. The United States appears to be facing such a decision again. Whether these institutions support a more stable and widely shared prosperity or contribute to greater fragility and inequality will depend on how clearly their role is understood and how carefully policy responds. The first step is to see them clearly. The next step is to decide, together, what role they should play in the economic and civic life of the country. That is a question in which every informed citizen has a genuine stake.